Hello, this is Garner Invest. Today we'll be talking about stocks that are unaffected by tariffs. So in today's video, we'll be covering two things. The first one will be on Trump tariff news as usual. And then the second portion, I'll be talking about stocks that are unaffected by tariffs, as well as the stocks that I'm looking at right now. So the first portion over here will be on Trump's tariffs. Yesterday, he basically said that he'll be imposing another 50% tariffs on China if they don't pull back on all the retaliatory measures that they did. So this will bring the total US tariffs on China to around 104%. That's just crazy considering they did a 25% back in 2018 already. So for Trump over here, I don't think he'll be backing down anytime soon. Same for President Xi. For the China side, they've showed that they're willing to fight the US by imposing all those retaliatory measures. And so I think this will be sort of like a long drought tit for tat that will continue on and on and on for the next few weeks or so. As for the market, so the S&P 500 is down around 18% from all-time highs. The Nasdaq is down around 22% from all-time highs. At one point during overnight trading, the S&P 500 was in a bear market, and then the Nasdaq was also close to around 30% down from all-time highs. It's recovered quite a fair bit already. So yeah, maybe this could be the bottom, no one knows. As for the markets in general, the market is still quite fearful. We're currently at a 4 times. That is lower than the COVID low. The COVID low was around a 6 on the Fear and Greed Index, and in 2022, the lowest point was at around 3, which we saw last Friday as well. Generally, the markets are still fearful, but I don't think there is extreme panic yet. As for stocks that are unaffected by tariffs, you have your software companies that are unaffected by tariffs, your semiconductor companies that are unaffected by tariffs. There's no reason for all these companies to sell off. And then you have companies that are reliant domestically, which are not so much affected by tariffs as well. But for today's portion, I'll be covering mainly the first two portions, the software companies, as well as the semiconductor companies, which were excluded and exempted from all the different tariffs. So the first company is S&P Global. So S&P Global is not really a software company, but it is a company that doesn't rely on so much of a physical product. In fact, they do sell software as well. They have the market intelligence side, they have all the data side, which is sort of like software as well. But the main business model for this one is their credit rating services. What they do is they just rate all the different debt and all the different bonds that all your different companies have to give out. So for this company over here, it is operating in a duopoly with Moody's, and currently the valuation is not too bad as well. So the stock now is currently trading at a price to free cash flow of around 24 times. That is one of its lowest points in the past few years. And of course, this stock may continue going down further if the general economy worsens, because the general economy worsens, people will stop raising debt, and when people stop raising debt, then S&P Global's earnings will be hurt. But overall, for quality business like this with no reinvestment, that basically does no capex as well, this is a quality entry, and this is a quality company for you to enter right now. And yeah, I think the valuation right now is not bad as well. It's currently trading at around a 25 times price to free cash flow. That is amazing for a company like S&P Global. Their PE is a bit inflated because they had an acquisition 2 years back in 2023 period. Next stock is Microsoft. So Microsoft is a Mac 7 company that is down around 15% year to date. It is down around 20% from all-time highs, and is currently trading at a price to earnings ratio of around 29 times. So for this company over here, it is just an extremely durable business. They sell software, they have the Microsoft 365, they have the Azure, personal computing, all those, they are all exempted from tariffs. And for this business over here, they actually were able to grow their revenue in 2022 as well as 2020. So this is an extremely durable business that can have basically multitudes of runways of growth. And this company is the company that survived through your dot-com crisis, your '08 financial crisis, your 2020 bubble, your 2020 COVID crash, as well as your 2022 tech bubble. So currently, the valuation is not too bad as well. This company is currently trading at a price to earnings ratio of around 28 times. And over the past few years also, the lowest point was at around 26.4 times in the 2022 tech crash. So overall, I think Microsoft right now is around fair value. It is a company that is providing you with a decent entry if you're looking to buy this company right now. So decent company, it won't be affected by tariffs at all. This is one that I've been looking into and buying as well. Next one is Google. Google is just a company that is so cheap right now, it doesn't really justify the valuation. So you have a company that is trading at 18 times earnings and 16 times forward earnings. And this company over here, it has been growing revenue quite steadily as well. Everyone talking about how the LLMs are taking over Google's market share. It's just that it's not showing up in the numbers yet. As for the valuation for Google, currently, Google's valuation is at around price to operating cash flow of around 14 times and a price to earnings ratio of around 18 times. Again, if you're to compare that to the 2022 tech crash, Google is currently trading at a valuation that is lower than that bear market year in 2022. and it is trading at a similar price to operating cash flow as well. So I think for Google, it is just simply a business, a high quality business that is trading so undervalued that it is a buy today. It's similar to Meta in 2022 when it had a 60% crash from all-time highs, which led to its multiple contraction to around 14 times, I believe. And so for Google over here, I see a very similar scenario. There's a company that is trading on sentiment, not so much on the fundamentals. The fundamentals are great for this company. It is not affected by tariffs, and yet it's sold off around 13% in the last month or so. So this is one that I've been adding to, although I have quite a sizable amount in Google already. I still continue seeing myself adding to it because there's no other company that is providing a better opportunity right now. Last company, ASML. So ASML over here, it is a company that has sold off a lot recently as well. Currently, in the past month alone, it is down 13%. Year to date is down 10%. And in the past year alone, it's down around 36%. So this company over here is an extremely monopolistic business. It is not affected by tariffs at all. So you have all your different other industries that are affected by tariffs, but for semiconductor industry, because the US depends so heavily on it, they have exempted the semiconductor chips and the semiconductor equipment from the tariffs. So for ASML over here, it is an absolute monopoly. It holds 100% market share in your EV space, 80% market share in your DV space, and just imagine everything around your house, all your electronic devices, they will rely on some sort of semiconductor which is made from your ASML machines, because ASML, they hold the greatest market share in all those different segments. They produce all those different chips for your appliances. So for ASML over here, it is a company that is recovering. It had a revenue growth of 2% last year. 2% last year was sort of like recovery phase for them. But based on their 2030 numbers that they gave out a few quarters back, the risk to reward for this company is just incredible. I calculated the fair value for this company. My fair value for this company based on their base case scenario is around $760. The lowest valuation is around $580, which it hit this morning as well. So this morning it was trading at around $580. That was the lower end of their guidance, which is around $580, and then the high end was around $1,100 as the fair value. So I think for this company over here, the risk to reward is simply incredible already, and that's why I have a sizable position in this company. I'm looking to see if I can continue adding all the way down, but it is getting quite big for me, so I am not planning to add unless it goes to around $500. So for ASML over here, I think it's a quality business I'm looking to add as well. Hopefully it goes down more so that I can add to it. Next portion. So last portion over here, these are some of my thoughts during this environment. So I think it's a manufactured sell-off. It is not so much an actual economic cycle. So if you were to look back at maybe the Asian financial crisis, for example, the Asian financial crisis was due to sort of like a bank collapse, and basically all the money coming out from your banks. If you were to look at your dot-com bubble as well, it is sort of like economic cycle as well. So they had a boom and then a bust. And then if you saw the housing crisis as well in '08, it was also a boom and then a bust. But in this scenario over here, it is all due to one man's actions, Donald Trump. And for me, I think it is a manufactured sell-off, not an actual economic cycle. And so it wasn't caused by an actual boom. And I think this sell-off has been so fast, and that's why I see the bounce coming in extremely quickly as well when we bottom out. I don't think we're in the bottom yet, so I don't think there's a lot of panic in the market yet. We only saw around 2 days of panic last Thursday and last Friday, and for Monday, which is today, the market hasn't really panicked on any of the news that Donald Trump came out with. So I don't think the market has bottomed yet. I think there'll be an ABC correction where we go down one leg, go up one leg, and then go down the next leg for a lower low. But we haven't gone down to the C correction yet. I think we're currently in the A phase, waiting for a bounce through the B phase. And so I'm still conservative in terms of my ads. I'm still around 40% cash. I'm looking to add all the way on the way down and save my last 10 to 20% if we go to the worst case scenario where the stock market crashes maybe 50% or so. Next portion over here, I think the markets are still not very undervalued. We're currently trading at around 18 times forward earnings, 24 times trailing 12-month earnings. And if you were to look at just the historical values over the past 10, 20 years or so, I don't think the markets are extremely overvalued. Maybe in the past 5 years or so, we're currently trading at around fair value. But over the last 20 years, we are not undervalued by any means. And so the markets over the past few crashes have normally bottomed out around between 13 times to 16 times forward earnings. Currently, we're trading at 18 times earnings. So we have around 10% more to go before the markets actually bottom based on all those metrics. But of course, we could just bottom here, no one knows. So let's see what's going to happen. So yeah, this portion over here is the S&P 500 forward earnings. Currently, we're trading at around 18 times forward earnings. And if we were to just look at the 2022 tech crash, it was at around a 16 times forward earnings. Same for the COVID crash as well. We bottomed out at around 16 times earnings. And for the 2018 Trump's tariffs and all that as well, we bottom at around 15 to 16 times forward earnings. So currently we're at an 18 times forward earnings. Let's see the market bottom out, but I'm hoping for more downside. I hope you guys have found this one useful. Invest safe.